TV, online and on your smartphone. This is Ticker News.
This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk and financial solutions.
Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Hi, I'm Chirs Judd and this is Talk Your Book, and today we're very lucky to be joined by Tom Lambeth from VP Capital, returning guest and crowd favourite. Tom, thanks very much for coming back on the show.
Thanks for inviting me, Chris.
Now, a lot of pressure, Tom. You've had a couple of big wins on this show. I think the Reject Shop, famously 7X post your appearance, Liontown with a takeover offer a month post your appearance. Are you feeling sort of the heaviness of success when you walk back into the studio today?
Let's see how we go on this one. This is certainly put the pressure on.
Not financial advice, of course, for anyone watching or listening. Down to business, what stock do you want to talk about today?
Cettire.
So talk me through the helicopter view of what Cettire CTT listed on the ASX do.
This is very topical because it's had a big run, as you'll see on the charts, but the business itself is a platform. So the platform allows consumers to buy luxury goods online. And your typical example would be a consumer who wants, Prada or Balenciaga. It's not your Chanels or your LVs, but it's 400 other brands below that. And it allows you to source a brand at a good price, probably better than your Collins Street price. And it also allows for the breadth of sort of range and different SKUs that may not be available in Australia, for instance, that may be available in the Italian market or European market. So it offers the consumer two advantages. From a VP Capital perspective, we like the business because it doesn't carry inventory, so it's capital light. And it's profitable, which is rare for an e-commerce and tech company these days. And then obviously it's growing. It's sort of close to triple digits per annum. And they had huge growth in the last quarter in particular. Talk us through the top line numbers that they announced recently. Yeah, sure. So there's probably two data points here. It's the May announcement when they announced that they were profitable and that April sales were circa 160% sort of year on year in terms of annualized run rate. And then there's the second announcement, which sort of happened a few weeks ago, where FY23 sales were reported up 90% circa year on year, and the company announced they made approximately $30 million of EBITDA, and so the cherry on top here is the July sales were disclosed to be 120% growth year on year, July 2023. So already FY24 is looking good. And I guess that's what one of the reasons why the stock's done very well, but it's super volatile as well. So they've got an interesting comparable with Farfetch, which is an international competitor. It'd be worth digging into comparing those two businesses, particularly around say employees as a percentage of revenue, which really compares favourably to CTT. What sort of metrics do you pick apart between Cettire and Farfetch that make you like what Cettire are doing? Yeah, it's an interesting comparison. So Farfetch is certainly the market leader in this space. They're much more mature. The business was started in 2007. And they're listed in the States, is that right? Listed in the States. It's headquartered in London, but listed in the States. And again, sort of founder-led. But the business was started in 2007 and Cettire was started in 2017. So there's a bit of a timing difference. I'll give you a stat which kind of resonates with us. It's the revenue per employee, which is just another way of expressing what you were saying. But Cettire generate $8 million per employee of sales. Farfetch generate $400,000 per employee of sales. So there's an efficiency issue in Farfetch, in our view. And I think without sort of being in the business and knowing exactly, but based on our analysis, it seems to us that the tech in 2007 was far less advanced than it was in 2017, and therefore the ability to use it to create efficiencies. And then sort of once you build the house on shaky ground or shakier ground, I think it's a lot more difficult to change it. Change your IT infrastructure, your policies, your people, and therefore there's a tendency to I guess become fat and lazy. And so that's certainly what we've seen with Farfetch. I think there's they lose money and they're highly leveraged.
And when you talk about the technology used by Cettire, they speak about their algorithm. Do you see it having genuine intellectual property value that is hard to replicate elsewhere? And if so, how long do you think that can last before others catch on and build a better mousetrap?
Yeah, I mean, to be honest with you, we think this tech thing is it's overplayed. Like there's ASX companies tend to, I guess, express the value in their tech as being, there's a high amount of IP, difficult to replicate. I think in reality here, what's going on is there's a will to execute by Dean Mintz and the management team to use the technology available. It's technologically enabled. Yeah. There's not like 1 or 2 lines of God code. It's not a competitive moat per se. I don't think the technology is a competitive moat in that particular sense. But what is a competitive moat is their willingness and they're able to integrate that technology into the consumer experience. And so, just to drill down on what that means, we think their information systems are really well integrated into their suppliers' information systems. Yeah, okay. So if I'm a consumer, I can get up-to-date inventory numbers, relevant price data for that inventory, things that are very useful and accurate to enable my experience to be a positive one, and that obviously drives efficiencies and therefore to some extent a competitive moat. Now, sure, other people can do that. The reality is Cettire have done it, and that's what counts, and they're still growing at kind of triple digits.
And getting back to Farfetch, they got absolutely smashed a couple of weeks ago when they reported their results. What was it that the market didn't like in them?
I think it's a few things. Firstly, to paint a picture on Farfetch, they're highly leveraged. This is a business which loses money, as we've discussed earlier, efficiency reasons and so on and so forth. They've also moved away from their core business and spent, $670 million buying brand businesses, and so that in context, they had some soft revenue numbers and guidance, basically US growth in particular and Chinese growth, and the market just sold it off 40%, as you alluded to. I think the whole package is what the market didn't like. It's all very well to have some debt and be loss making with a view to eventually making profit based on growth, but as soon as your growth drops off, that's what the market didn't like.
And you've mentioned their Cettire's growth recently, which has been astronomical, but there's been a few red flags or things you've got to get comfortable with as well. From my perspective, direct to selling would be a big one of them, with the founder selling about $100 million worth post results, and then 2 other directors selling since. How have you been able to manage that? And do you think there's any more sales likely to come in the near term?
It's hard to defend, objectively, but keep in mind, from Dean's perspective, he's allowed to sell. Everyone's got a different risk appetite. That's the other thing. I think it's heavily personality driven. Now, we've seen opposite situations where founders haven't wanted to sell, or sometimes they're buying, and it's not always indicative of what happens to the share price or the business. And in Dean's case, he still retains 37% of the company, which is $370 million of mark-to-market value, superior than the money he's taken off the table. That said, I think it's a small negative. The other 2 directors, to be a bit tongue-in-cheek about it, they have, I think, a few $1 million of stock collectively. I'll cheekily suggest that that perhaps they weren't smart enough to get enough stock originally. So what makes you think they're smart enough to be selling at the right price now? So, but in fairness though to them, I think directors have windows to sell, and this is one of them.
Sounds good. We'll be back with more Talkie Book after this short break.
This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk and financial solutions.
Yeah, Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
This is Talk Your Book, and again, very lucky to be joined by Tom Lambeth from VP Capital. Tom, touching on a couple of perhaps challenges that Cettire are facing. Obviously, there's been plenty of blue sky recently. Outside of direct to selling, when we look at their tech expense and the fact that they capitalise it, how do you sort of get comfortable with that? And what sort of percentage do you generally like to see these types of businesses capitalising in terms of their tech expense?
Yeah, I think it's an interesting question. I think you've got to look at, as an analyst, like the three statements. You've got to look at P&L, balance sheet and cash flow. I think, to your point, not all of the IT expenses going through the P&L. So I think last year they had $4 million, which was amortised, and I think in the cash flow statement it says they actually spent 12, so they've capitalised 8. Now,
what's stock standard? Like, is 20% stock standard you capitalise? Like, does that seem high to you, or not necessarily?
It didn't necessarily seem high to us. It obviously depends on what kind of individual items that you're spending money on, and what kind of IT equipment. So the accountants will also sort of say, well, you can't just expense it all because the useful life is more than a year, so it's unfair. But I think it's a valid point because it goes to sort of earnings quality. I think if you're worried about that, our view would be you wouldn't just sort of hinge the whole investment case on whether they're capitalising earnings too much or too little. Capitalising expenses too much or too little. I think in this case, it's a small negative which goes to earnings quality. It's something to watch in the medium term. It's not something to sort of get hung up about when they're printing 30 mil of EBITDA and growing at 100%.
And the emerging market revenue growth was super strong recently and has been. Do you think that's something that's going to continue in the near term?
Possibly. I think the same question applies to emerging markets as it does to established markets. And so, emerging markets like some of the Latin markets they're rolling out in. Spain's a big one for them, which is growing at triple digits. The core markets such as the US, I think it's growing more around that 70% mark year on year. But it's the same question. It does sort of luxury goods. Do consumers want to long-term buy luxury goods? It's kind of like the democratization of this luxury goods sector, and it's a $400 billion market globally, including in-store purchases. A very small amount of that's online. Cettire obviously has like much less than 1% in terms of share. So to me, it's quite asymmetric. Like there's room to grow here. I'm obviously betting that they will be able to capture more share in emerging markets and in the core markets. I think, in the short to medium term, I think it's the US market. It's the biggest middle class in the world. It's 60% of their business. That's what I'm kind of focused on. I think the emerging markets are nice. There's Japan and China coming up in terms of advanced East Asian economies. There's Taiwan, Singapore, and then there's Latin America. So I think the US market is still core in the short to medium term though.
And they charge from returns, which not all their competitors do. What percentage of revenue comes from returns, and do you view that as sort of a sustainable revenue line, or do you think they'll end up having to do returns for free like some of their competitors do?
Yeah, it's interesting. So they do have $500 million of sort of notional sales, and then about 20% of that gets chopped off in terms of when to get to a net sales number post returns. I think $30 for a return, and then higher if you're returning lots of goods. It's not ideal from a user experience, a customer experience perspective, but I do think. Not to sort of sound arrogant, but the growth is ridiculous, and so clearly there is a value proposition for the consumer. And it's
cheaper in the first place, isn't it? You've got to take some risk on as the consumer to get the cheaper product.
Yeah, I suppose so. In my mind, it's something you perhaps look at fixing later if you need to improve the customer experience.
Yeah.
And there are many levers you can pull as well. I mean, local sort of pricing is the other one. They could roll out local pricing in local currencies more effectively.
And we'll finish up after this question, but when you look at it, where's the next re-rate come from?
I think it's just based on fundamentals. So it's those two levers around the market realising the execution story. So, does Dean continue to execute in the way he has? And if they end up growing at 100% again for FY24, July's on track. What's EBITDA? It's EBITDA 50 million, and if it's 50 million, it's on circa 20 times FY24 EBITDA. It's on 35 times FY23 EBITDA. Honestly, I've seen companies even now trade on much higher multiples for the type of growth that we're seeing, and that's why we like it. So I think it's a case of there's no sort of big M&A event like Liontown. It's more this one's more of called a medium-term story that we're suggesting.
Well, always appreciate you coming on. Always learn a lot listening to you speak. So thanks very much, Tom, for coming back on the show.
Thanks, Chris.